I'm going to explain how to buy your next rental property without using any of the cash in your savings account. So you bought your first rental property and you've spent time and money to rehab it and get it stabilized by getting good long-term tenants, and you're finally looking to buy your next rental property so that you can do it again and eventually have enough income to replace your full-time job. Right? Easy, right? Just get a loan each time. Burn that. When you get $100,000 house or $1 million house, you're going to have to put some money down as a down payment to show you've got skin in the game. You've got to pay for the property taxes and insurance, homeowners insurance and landlord insurance up front. You've got to pay origination and underwriting fees. Let's say, for the sake of argument, you get a zero down payment loan for $1 million. Well, you still got to bring 3% of that just for the origination fees, and then maybe another percent or two for closing costs, which includes underwriting fees. So you're looking at total 5% of $1 million. That's at least $50,000. That's still cash that you saved up, that you worked hard to save up, and cash that you may not have, especially if you're already living off the rental income as your primary source of income. Here's the real problem. Wealth is infinite, but cash is finite. What I mean by that is property values can change. You can buy a home for $100,000, and 5 years later, it's worth $500,000 or $1 million. But the amount of cash that you have in your savings account, $50,000 over 2 years on your previous rental, you're still stuck with just that $50,000 that you have left. And you need that $50,000 for repairs, leaks, toilets, move-outs where you got to rehab an entire unit. Or worse, your homeowner's insurance policy, your landlord insurance policy doesn't have service line coverage. So that's $5,000 to $10,000 that you got to spend out of your own pocket to do those repairs. And if those repairs pop up after you've already put $50,000 towards the purchase of a new home, well, now your bank account is empty and you don't have the money for those repairs. And let's say there's an act of God like a pandemic, or an act of government like a rent moratorium during a pandemic. So now your tenants aren't paying you, you've got no cash flow, but you still have to make the monthly payments on the mortgage. You still got to pay property taxes. You still got to pay the homeowner's insurance bill. You still got to pay for repairs out of pocket. It gets expensive to use your own cash reserves to purchase the next property. So what are some solutions to that? The cash out refinance, you're basically taking a new mortgage at the higher valuation of the property. Remember, wealth is unlimited. Property values increase either due to inflation or supply and demand. And so you take out a new loan, you pay off the old loan, and you take some cash out based on the increase in property values. And you use that cash to make the purchase. Well, the problem with that is maybe your old mortgage was at 2% interest rate and your new one's at 5% interest rate. The problem with a HELOC is that your old loan stays in place and they give you the line of credit on the appreciation in the home values. So let's say you've got $1 million home, it's gone up to $1.3 million, so you've got $300,000, and even if they do 80% of that, so they give you something like $200,000 to use towards the purchase of your next home. Well, yeah, you're not having to pay for that with the savings account, but you still got to make monthly payments, even if it's interest-only monthly payments on that $200,000. Either way, with the cash-out refinance at the higher interest rate and the higher loan amount, or the HELOC with the interest-only payments, they're both eating into your cash flow of the old building. So that means you're earning less now. You're burning through cash. You're just doing it at a much slower rate. And then there's equity sharing. Imagine buying a piece of a company. Let's say this company is worth $1 million, and you're giving them $200,000 in order for 20% of that company. And when they sell the company in the future, they have to pay you your 20%. The value goes up to $2 million. They sell it, and now they have to pay you 20%, which is $400,000. That's more expensive than the cash out refinance. That's more expensive than the HELOC. You're just deferring the pain until much later. But there's still going to be pain.
Humankind cannot gain anything without first giving something in return. To obtain something of equal value must be lost. That is alchemy's first law of equivalent exchange.
Anyone familiar with Full Metal Alchemist will understand that in order to get something, you have to give something. This is not some social media something for nothing scam, because you still have to give up something in order to get something. And that's where cross-collateralization comes in. What is cross-collateralization? Let's say you go to a restaurant and you're dressed nice, you put on your Rolex, it's got 10 diamonds on there, and each one of those diamonds is worth $1,000. you rack up the bill at the restaurant, the check comes in, and it says it's for $500. Well, in your rush to get dressed up nice, you forgot your wallet, you forgot your card, and you had no cash to pay. So you say, restaurant owner or waiter, and this restaurant has done this for other customers because they're customers, so they have good credit with the restaurant. So they say, hey, just put that on my tab, and when I sell this Rolex, I'll give you $500 from that sale, because look, each of these diamonds is worth $1,000, and I've got 10 of them. That's $10,000. So when I sell this Rolex, you know I'm good for it. And so they put their claim on one of the diamonds or half of the diamonds on that Rolex watch. So that's what cross-collateralization is, and it works great for investors who have at least one property in their portfolio. The lender puts a lien for the amount of the down payment and closing costs on the old investment property. So let's say you have another $1 million property. You've got a mortgage on it for $500,000. Well, that means you still have $500,000 in equity on it. Well, they'll put a lien on the old property for $250,000 plus closing costs of $275,000, and then they'll lend you the remainder, the $750,000, on the new property. So the benefit of that is that you've not touched any of the cash, which you can now use for repairs. So you're making improvements. This $1 million building that you bought was really trash, and you had to put a lot of your own cash that you'd saved up into doing the rehab. And now it's worth $1.5 million because you've got good long-term tenants in there at market rates. And the way you get out of that lien is by either selling the new property and you take the proceeds from that to pay off not only the original loan, but the down payment or the lien from the old property, and then you're left over with the profits from that. The other way you can do it is do a refinance, either cash out or a rate in term, depending on how much it's appreciated, and use that to not only pay off the original mortgage amount on the new building, but also the down payment and closing cost amount on the lien of the old building. So either one of those strategies allows you to protect your old buildings and still have the cash to do what you need to do to better the current building. So if this sounds like the boat that you're in and you'd like to see if this option is right for you, contact me to see if I can help.